Today, we're looking at an analysis of Bitfarms and their Q3 2025 performance. The report highlights this massive 156% revenue explosion, but it's set right against a pretty substantial net loss of around $46 million. All of this is happening while they're making a big, expensive pivot into AI.
Yeah, it's a report that's really built on tension, isn't it? I mean, you've got a company with record-breaking revenue that is also, hemorrhaging money, but for a very specific reason, this strategic transformation. It's a bullish story, but the structure, right now, kind of gets in the way.
That contradiction is exactly what jumped out. It's a perfect example of how the way you structure a report can almost work against your own argument. And that brings us right to our first point, which is all about structure and flow.
Right. So the presentation of the Q3 performance creates a narrative whiplash that initially dampens the impact of the explosive 156% revenue growth.
A whiplash. Yeah.
The material sets up this huge bullish headline in Section 1, The Explosion Explained, with the $69 million success. But then it holds back the full context until Section 2, The Bad, where you get the EPS miss and that $46 million loss.
I get the impulse, You want the reader to feel that big win first. But when you separate the good news from the bad like that, doesn't it almost makes them feel unrelated?
Mm-hmm.
You get hooked on the revenue number, and then you have to process the loss on your own and figure out how they fit together.
Exactly. That's the problem. The structural separation forces the reader to do all the work. They absorb the success, but then later they have to reconcile it with these negative numbers in a different section. So by the time they get the explanation for the loss, they've already kind of mentally marked the company down because they saw that negative EPS number just hanging there.
So the report is making the reader do the heavy lifting of justifying the strategy instead of doing it for them. We need to frame that short-term pain as the price of admission for the long-term gain.
Precisely. So the suggestion here is to integrate the high-level financial outcome, both the good and the bad, the growth driver and the loss driver, much closer together. Put them in the executive summary right at the start. That immediately establishes the core tension, and it sets the stage for the rest of the report to explain why that tension is actually a good thing.
Okay, so you're making the structure serve the argument from the very beginning. Can you give a concrete example of how that would look?
I mean, how do you do that without watering down the impact of that big revenue number?
Sure. So in the executive summary, right after you hit them with the 156% revenue figure, you add a sentence, something that links the growth to the expense. For instance, you could note that this impressive growth is what's providing the capital to fund this expensive transformation. And then mention that, yes, transition costs from exiting Latin America and some non-cash charges led to the net loss.
That's so much more powerful. It instantly reframes that negative EPS. It's not a failure. It's a strategic investment cost that the massive revenue is actually paying for. It shifts the whole narrative from an EPS miss to a fully funded strategic realignment. That reframing is absolutely critical. And, speaking of critical assets, that brings us to the second point. It's about an asset that can get overlooked in these kinds of pivots, the sheer power capacity. The report makes a great case for the AI pivot, especially the Washington facility conversion for NVIDIA's new GPUs. But there's this theme from analysts in the report that feels a little underused, and that's the value of their power portfolio.
Yes. To maximize the bull case and justify the valuation re-rating potential, the report needs to more deeply establish the scarcity and strategic value of Bitfarms' power assets within the broader AI infrastructure discussion. The argument, as I see it, is that AI needs huge, secure power. This company has it, especially with those hydroelectric contracts.
Right, it's laid out. But the weakness, I think, is that Section 4 mentions this key insight that the power portfolio is an undervalued asset in an AI world, but the section before that, Section 3 on the AI pivot, it focuses almost entirely on the tech. The specific NVIDIA GPUs, the liquid cooling.
And is there a risk there? By focusing only on the GPUs and the cooling, are we overlooking the number one constraint for any of these big AI projects? Which is, can you actually get the power? Long-term, scalable, cheap, and secure from grid problems.
That's the real competitive advantage, isn't it? That's the moat. The report almost presents the power portfolio like a nice little bonus, when today, secure, cheap power is probably the single most important factor, especially with data centers everywhere hitting power limits and costs going through the roof.
Absolutely. So our suggestion is to explicitly connect the power capacity, especially the hydro contracts, directly to the competitive advantage of their whole HPC transition. The report should position that power portfolio as the main de-risking factor. It makes the whole re-rating argument much stickier.
That makes so much sense. I mean, the bottleneck right now isn't even getting the chips from NVIDIA, they're shipping them. It's finding a place where you can plug them in, where you can pull 50 megawatts without waiting years for permits.
Exactly. We have to communicate that scarcity. We need to move the power asset from being sort of a footnote about what analysts think to being the core engine of the company's future value.
So how do we make that connection more tangible for someone reading the report? How do we tie it back to that Washington site?
Okay, so when you're detailing the Washington site conversion, you need to really strengthen that link. Emphasize that the secure, low-cost hydro contracts give them a material, long-term operational advantage that other AI infrastructure plays just don't have. You could even say that the reliability and low-carbon footprint of hydro drastically lowers their OpEx compared to peers who rely on, say, volatile natural gas. That's what justifies the high price target of $6.40. They have the single most valuable resource in the AI economy: cheap, sustainable power.
That kind of linkage really does strengthen the whole thesis. It highlights the scarcity. Now, let's circle back to that financial miss, that $46 million net loss. This brings us to our third point, which is on completeness and focus.
Right. The current explanation for the $46 million net loss requires greater contextual detail to ensure the reader fully accepts these costs as genuinely one-time expenses, rather than indicative of systemic operational difficulties. The report says the market often forgives these kinds of costs, but, just stating that isn't enough. The report has to force the reader to forgive them by being more transparent about what those charges actually are.
Just to clarify, when we say non-cash impairment, what are we talking about here? Is it mostly older Bitcoin mining gear that's less valuable now that they're shifting to HPC?
That's generally what it is, yes. A non-cash impairment just means the company is formally acknowledging that some assets on their books, like old miners, are worth less than they used to be. It creates a loss on the income statement, but it doesn't actually drain any of that $800 million in cash they have. It's a bookkeeping move.
I see. So the weakness then is that the justification for the whole loss is a bit too general right now. It just says non-cash impairment charges and these vague costs associated with exiting Latin American operations. That generalization, it makes it hard to be certain that the entire $46 million is a one-time cost. Could a skeptic argue that some of it is something else?
That ambiguity creates doubt. And doubt is the enemy of a high multiple re-rating. So to counter that, our suggestion is to refine the explanation in Section 2. If it's possible, provide a clearer breakdown between the financial hit from the non-cash impairment versus the specific costs of shutting down in Paraguay and Argentina.
So you're anchoring the narrative. You're showing that this $46 million loss is the direct, unavoidable price of shifting resources to the U.S. market, which has a higher valuation. It has to feel intentional.
Exactly. You want the reader to feel like they know exactly what they're buying with that short-term volatility. And here's a concrete way to do that. Frame the discussion not as just a financial miss, but as an intentional decision. A decision where the short-term negative EPS is the cost of acquiring that long-term benefit of being an AI infrastructure company.
Breaking down the cost would help a lot. Like instead of just exit costs, you could state that these expenditures, the impairments, the exit cost, are the necessary steps to unlock that 4.25 average price target and the massive upside to 640. By breaking it down, even just conceptually, you show the reader exactly what's being purchased. A focused, high-multiple AI play cleaned up from its legacy assets. This has been a really targeted critique. It's all about making sure that bullish narrative is supported by a total